Inflation is at a 40-year high, interest rates are rising, and gas prices have hit a frightening $5 a gallon. The stock market is taking investors on a roller coaster ride with terrifying drops. Cryptocurrencies are crashing. Annual inflation rate in the US unexpectedly accelerated to 8.6%. Energy prices rose 34.6% due to a rise in gasoline price up to 48.7%, fuel oil up to 106.7%, electricity up to 12%, and natural gas up to 30.2%. Food costs also surged 10.1%. Big increases were seen in the price of meats, poultry, fish, eggs, and groceries. And now you're hearing that we may be in a recession or one is inevitable. Welcome to Recession Preppers. Make sure to stay tuned till the end. Inflation remains stubbornly high in the United States, reflecting global food and energy shortages caused by the Russia-Ukraine conflict, as well as the high momentum of domestically determined prices like house prices, rents, and medical care. But inflation is not what people are most worried about. It's the possibility of an inevitable recession. Before getting further into this topic, it is important that we know what is a recession and why does it occur. A recession is a significant decline in economic activity that usually lasts for a few months or even years. When a nation's economy experiences negative GDP, rising levels of unemployment, falling retail sales, and contracting measures of income for an extended period, recessions are considered an unavoidable part of the business cycle or the regular cadence of expansion and contraction that occurs in a nation's economy. You may lose your job during a recession as unemployment levels rise. Not only are you more likely to lose your current job, but it also becomes much harder to find a job replacement since more people are out of work. People who keep their jobs may see cuts to pay and benefits and struggle to negotiate future pay raises. Investments in stocks, bonds, real estate, and other assets can lose money in a recession, reducing your savings and upsetting your retirement plans. Even worse, if you can't pay your bills due to job loss, you may face the prospect of losing your home and other property. With more people unable to pay their bills during a recession, lenders tighten standards for mortgages, car loans, and other types of financing. You need a better credit score or a larger down payment to qualify for a loan. That would be the case during more normal economic times. Even if you plan to prepare for a recession, it can be a frightening experience. While there is no fixed cause for a recession, some recessions can be traced to a clearly defined cause, while some may not. For instance, the recession of 1973 to 1975 began as a result of the 1973 oil crisis. However, most recessions are caused by a complex combination of factors, including high interest rates, low consumer confidence, and stagnant wages or reduced real income in the labor market. Economists determine whether an economy is in recession by looking at a variety of statistics and trends like rising unemployment, rises in bankruptcies, defaults or foreclosures, falling interest rates, lower consumer spending and consumer confidence, falling asset prices, including the cost of homes, and dips in the stock market. All of these factors can lead to an overall reduction in the GDP of a nation. We can clearly see that situations are very similar recently. Multiple signs point to a downturn on the horizon: persistent inflation, crashing crypto markets, and the lowest consumer sentiment since records started being kept. But exactly if or when a recession will happen, which is defined as 2 quarters of negative economic growth, is unclear. Although it is impossible to know for sure, the odds of a recession in the next year have been steadily rising. According to a recent Bloomberg survey of 37 economists, they have the probability pegged at 38%, which is double the odds from 3 months ago. A key indicator of a possible recession is the real gross domestic product, an inflation-adjusted value of the goods and services produced in the United States. For the first time since early in the pandemic, it decreased at an annual rate of 1.4% in the first quarter of 2022. Since many economists agree that 2% is a healthy annual rate of growth for GDP, a negative quarter to start the year suggests the economy might be shrinking. Another factor is rising inflation. With a high rate of inflation, higher prices outpace wage growth, making things like gas and rent more expensive for consumers. For that reason, the Fed imposes interest rate hikes, as they did in March and May, with 5 more expected to follow this year. These hikes discourage spending by making the cost of borrowing money more expensive for businesses and consumers. Inflation is certainly not decelerating as quickly as markets and the Fed had hoped. What we're seeing is that sticky price measures are high, and the signals are that input prices continue to move up faster than people had discounted. Either markets and the Fed accept higher inflation, or policymakers really do pursue higher interest rates to combat inflation. Either way, that's bad news for the economy. By the end of 2022, we do expect some of the supply-driven issues to fade, allowing headline inflation to ease. However, the longer high inflation persists, the stickier it gets. If there is ultimately a recession, it would likely be relatively short. The economy isn't looking super great at the moment. Although the news is troubling, there are steps you can take to stave off panic and protect yourself as best as possible during a downturn. Tackle your all-high-interest debt first and build an emergency fund because it's no guarantee that your primary source of income will last forever. So it's always better to be prepared and hope for the best. That's it for the video. Feel free to share your opinions in the comments below. And don't forget to hit the like button, subscribe to the channel, and press the bell icon to stay updated about our next video.